Options trading. Why start, and if you've already done so, what else can you explore on the Moomoo trading app? We're about to find out. Welcome to Investing Explained, where we make your money work harder for you. For this episode of Investing Explained, we've put together a series of options trading episodes for you, starting with the covered call strategy. Hear directly from our trading representative, Lee Yongshern. So Yongshern, tell me all about the covered call strategy, why use it, and why is it important during these market conditions?
Hi Olivia, it's a good question. Covered call strategy is very important, especially during this year, 2022. Because of this downtrend movement in the market. A lot of people who are holding the long position does not know what to do with their existing US holdings and how can they generate some cash flow by selling covered call. So let me tell you what is covered call. Covered call is a strategy that consists of holding a long stock position and also sell call positions on the same underlying. If you are holding the underlying stock and corresponding short call position on the same underlying, you have created a covered call strategy.
So what are the requirements to create a covered call position on Moomoo?
So first of all, you need to ensure the number of shares that you are holding must be equivalent to the number of shares implied by one option contract. In most cases for US option contracts is 100 shares. That means to create a covered call position, you must have at least 100 shares of the underlying and also one short call option in order to create this covered call strategy. So for example, if you are holding 100 shares of company ABC, you can sell a call option to create this covered call position. Let's say if you have 105 positions, you can also open with one option contract. However, if you only have 99 shares, you are not eligible to create this covered call positions for those option contract with 100 shares multiplier.
So Yongshern, how can we actually trade this on the Moomoo platform?
Log into your Moomoo desktop app or Moomoo mobile app. Go to your watch list, select a counter, go to options, select call, and also choose the expiration date. Double click on this option or any option, click on trade, enter the quantity, and click sell. If you want to ensure that you have sufficient underlying to initiate this covered call, please go to this trade tab to check your existing positions on your Moomoo app. So usually you will need to hold the underlying share first. For example, you're holding 100 shares before you sell these call options, which means that you need to have the share before you get the margin waiver for this covered call position.
Of course, Yongshern, with every single strategy, we'll always want to know what the benefits are. So what are the benefits of the covered call strategy?
As compared to other option strategy, when you are selling a naked call, you are exposed to unlimited risk. Whereas if you're holding the large position of the underlying, which means that most of the people who create this position, they have studied about this company, they know the fundamental of this company, they know the risk of investing in this company. Right now, instead of just having this position stay idle or waiting for the capital gain or any potential dividends in the future, you can just use this option by selling an out of money call, for example, and you can collect some premium to create some cash flow in between while you are waiting for your expected result to turn out.
And with that, we always look at the flip side. So what are some of the risks associated with the covered call?
Wow, Olivia, you have so many questions. I like it. So first of all, the risk is when the stock price plummets, you are also subjected to the capital loss risk. Why? Because this covered call does not play a role as a hedging instrument. Because you have heard of option can be playing an important role to hedge your existing positions, but doing a covered call would be just like you are putting in additional tool like a limit order, like I mentioned in the benefits. The second risk is there will be a cap in the potential gain since you have sell call option, which means you are obliged to deliver the underlying position if it hits a strike price. So let's say your strike price is $110, but the strike price went all the way up to $150. You will not get to make the additional profit between $110 and $150. So your gain is capped at $110. And thirdly is For covered call particularly, this margin waiver is only applicable when you are holding the underlying position. Let's say you want to liquidate your holding for whatever reasons, then you will be subjected to the margin requirement for the sell call option. In my opinion, a lot of seasoned investors, they like to do covered call position. Why? Because with their large holdings, they are not going to liquidate anytime at the current price. Then they will use this covered call to put a sell price and also generate some cash flow. Secondly, I would think that the seasoned investor, they are buying into some companies which has a larger cap, and they would like to hold this position. With these large cap companies, the fluctuation is there, but it's not as huge as some of the small cap counters. So with this strike price, I think if they're putting it far away from the current price, this will not cause the position to be delivered so soon.
So Yongshern, you covered the why, the several strategies and scenarios, but what about the how?
Olivia, I knew that you're gonna ask me this question. Thankfully, Yongshern is always prepared. Let's look at the screen. On 1st of November 2022, you saw a company ABC $100 call option expires on 20 January 2023 at the market price of 50 cents per option contract. So the underlying was traded at $90 and the premium collected is $50 because of the 100 contract multiplier. So 50 cents times 100 equivalent to 50. So if you look at this chart, your break-even point is 99.5 because of the 50 cents collected for this option. And when the share price is at $100 or even higher, your profit from this option position will be $50. So at expiry next year, when it is in the money, so the underlying share price is traded above $100. For this case, it's $101. So the underlying will be delivered to the buyer of the call option at $100. Or if this option expires out of the money, which means that the underlying is $100 below, for example, is $99, the seller of the covered call will get to maintain its existing holdings and the sell call position will lapse at 0. Stay tuned if you want to find out more about our options trading strategies beyond covered call. Back to you, Olivia.
Excellent, Yongshern. To the audience watching, let's go beyond the covered call and explore other options trading strategies for the month of December so that we can guide you in your investment journey. For more videos like this, do like and subscribe. Let's get to work. Have a profitable day.